Hi, everybody. My name is James Gathil, and I'm an editor here at Afronomicslaw.org. We welcome you to this webinar on taxation and the social contract in a post-pandemic era. This webinar is organized with our colleague, Dr. Alexander Ezenagu, who has more energy than anybody that I know, who openly admits he doesn't sleep. He is an assistant professor at the Hamad Khalifa University in Qatar and a senior fellow for the Center for Economies of Africa. And we are delighted to be collaborating with him. He has helped assemble this very star-studded group of speakers. And before I hand it over to him, I just want to say that in addition to being very grateful, this webinar series is intended to create a space for those of us who are very interested in issues of social and economic justice in areas like tax law, trade, investment law relating to Africa and the Global South in general. And we're delighted to be providing this opportunity for all of you out there listening, watching. And so without further ado, I want to hand it over to Dr. Ezenagu.
Thank you, Professor James Gathil. Thank you to everyone. First of all, thank you to the panelists for agreeing, but big gratitude to everyone who wrote for the tax symposium, which has kind of led to this webinar where we've been able to sort of gather some of the meat of the conversation and decided to have this webinar to discuss further the interaction between taxation and social contracts. And I look forward to a very enlightening conversation. We've also tried to get everyone from different backgrounds, diversities, just so that the question can be reached. Without spending much time introducing, I would sort of just call on the speakers, and they are at liberty to introduce themselves and what they do. So at each point, I just call on the speaker, then you can introduce yourself further as you give your own sort of address. So the first speaker who would give sort of a keynote reflection is Dr. Mrs. Oby Ezekwesili, who's been for me one of my role models for a long time. I remember some years ago at the Oxbridge ceremony in Nigeria, she gave the keynote speech, and that was really charged up. I know I didn't ask for a photo, but I was in the audience and sort of just there learning, and for someone who studied at Cambridge, it was quite interesting to be able to get that connection between public sector and also academia. And today I'm really, really grateful that she has accepted sort of, help us tie in this conversation together more from a policy angle, from an economic angle, and what we should think about going forward. Thank you, Dr. Ezekwesili, for accepting my invitation, and I hand over the podium to you. Thank you.
Thank you so very much, Alex, and thanks to all your colleagues and friends at the Afronomics for this opportunity to join you in this very important conversation. I think that the topic you chose, taxation and social contract in post-pandemic era, is quite thoughtful, because this is a very important topic that anyone who is a political leader or a policy practitioner within government or outside of it should really be giving a lot of thought to. This is for reasons of what you and I know. We were already struggling in terms of the social contract that held the world together, whether as a global family or within nations. And so the denigration or perhaps the derogation of social contract over these many decades of our seeming prosperity it has come to a head because now a phenomenon that has really laid bare the kinds of disparities that we have in economic fortune has hit us. And so we can't simply pick up and just keep going. So forcing ourselves to have this conversation is a very important thing. And so it is great that you started this off. I want to, I'm not sharing my screen, but I would ultimately send a piece of PowerPoint to you that lays out some of the thoughts that I'm putting forward. So in my first, I just give the coronavirus statistics, and I talk about the fact that as of today, we're talking 21.8 million cases around the world. And we're talking of close to 1 million deaths now, 773 deaths. Currently infected people, about 6.5 million. Recovered people, 14 million. I think that that's a really important piece of news, that recovery can be that much. Then I looked at the economic impact, and one thing that tells you how much of an... I'm getting a feedback. Is it me? Or is everyone hearing me?
Yeah, we can hear you. Go ahead. We'll find out where it's coming from. Sorry.
Excellent. So in terms of economic impact, some piece of data there. Some $9 trillion is what global stimulus amounts to, in order to respond to the impact of this pandemic. $9 trillion. That's so significant. And this is tracked by the IMF, a sister organization to the one I worked for. And then it says, in terms of job losses, we're talking some 400 million full-time jobs projected by the United Nations. And in terms of revision of global growth, we're now at minus 4.9%. And then when you look through selected markets and indicators and commodities, you just see that we really have had a very significant factor that has changed the world as we used to know it before the pandemic. And so I then go on to say, so as you laid out in your topic, what is social contract? And I say that, well, social contract is derived from the theory of social contract. So whether it's Locke or it's Russell or it's, Hobbes, name whichever of the philosophers you care to, this emphasis on the fact that a person's moral and or political obligations are dependent on a contract or agreement amongst them to form the society in which they live. And that in so doing, we can actually simply say that social contract is the agreement between people to uphold reciprocated duties between themselves. The premise of the agreement is, of course, that the sovereign which they agree to all give this power to will be committed to the good of the individuals who constitute society, and that each individual will be likewise committed to the good of the whole. And then I go on to say that it is when free and equal people within a society collectively renounce some of their individual rights and freedom and transfer them to the collective body or a new entity or personalities from that agreement, and they accord the power of the sovereign to it. The individual wills that remain with the people to further their individual interests are there, of course. But then there is the general will, which once it is formed, is supposed to be directed toward the common good and agreed collectively. It is agreed collectively. So what does this social contract have to do with tax? Well, it just seems to be that taxation is the best example of social contract, because this is about the state creating prosperity together with the people, and as a consequence, the state requires a commitment from the people through tax payments that it can carry out that collectively agreed purpose for which it exists, so that the raison d'etre or the leitmotif for the state is established through the fact that citizens are willing to part with their money as tax payment to society, so that government can provide common good. There is public good and there is private good. When it comes to public good, it is the fact that there is a tax relationship between the people and their government that provides the context in which such common, public solutions can be found to aggregate problems. The mechanism of tax compliance can be developed through the perspective of social contract theory based on the freedom, common interest, and the reciprocity that exists in that relationship. So I then show, what has happened in terms of taxation, the historical trend. There was a time when, centuries when the tax was not the basis for, the state having money. The state sold land. It sold, whatever else it had control over. But taxation as a tool of raising revenue for the nation state began to form itself around the concept of social relationship, social contract, somewhere in the 1600s and beyond. So I then talk about the fact that Africa, for example, is a reflection of how in taxation, developed economies tend to raise more taxes than developing ones. And many factors account for that. Whether it's in terms of just the maturity of the economies, the kind of tax base that they have grown, in terms of the capacity to administer tax, in terms of many other factors that adaptation to technology, and the fact that there is a debt, economic debt, that low-income countries haven't attained. And, so when you look at what usually measures comparability so easily, it is to look at a country's, taxation revenue as a percentage of its GDP. And globally, you see things that go from, on the average, from 20 to 25%, with some of them hitting beyond that. But on the continent, on our continent, the average, as of between 2008 and 2017, the average African tax to GDP ratio increased by 1.5 percentage points, and it went to in current numbers, it's 17.2%, and it's mainly due to revenue increases from value-added tax, which of course is very much different from when you talk about income tax, the direct income tax, and the fact that somehow African countries that have figured ways to collect this tax at source have managed to almost put a greater burden of tax payment to those that are within the formal net. Those that their lenses can find. The informality of the material informality of the African economy means that there are so many that are outside of this formal net. And for those that are outside of this formal net, it doesn't mean that they don't pay taxes. It just means that they pay taxes that cannot be accounted for. Because sometimes they bear the greater burden of taxes. And so the people at the bottom of the pyramid are faced with informality, and yet that informality shows up in the unrecorded, many black leg taxes of all kinds that are dumped upon them. But back to the matter of taxation in Africa, tax to GDP ratio, it's interesting how it's almost a scattershot of performances. In a country like Nigeria, our number is terrible. Our number is some 5.7%. It's crazy. You look at some of the other countries. Tunisia has got 31.2%. Seychelles has got 31.5%. South Africa is at 28.4%. Nigeria's problem is, of course, that we have a very funny elite class that's comfortable with oil being the major source of our public budget, revenue. And that's a problem. That's even going to be a worse problem post-COVID, because we already saw the classic syndrome of volatility that goes with, an economy that is monolithic in nature. So here we are, with a very low tax revenue to GDP base. And that tells you something about our GDP. It shows a low productivity of the rest of our GDP because oil has increasingly declined in the structure and composition of our GDP. It's gone from the years when it used to be some 40% in the 80s, 90s, to today's number of below 10%. And yet it accounts for more than 75% of public revenue. However, in terms of its measurement to GDP, you see how low that is. It really is a serious dilemma for countries like ours. It's the same story in places like Equatorial Guinea, DRC, those places where Dutch disease is a problem. So I then say, what are the structural barriers to Africa's taxation revenue so that if we want to improve domestic revenue mobilization, what are the issues that this post-COVID would compel us to focus on? So I talk about weak state capacity to collect taxes. This is so prevalent on our continent. It's a challenge, it's a challenge. And then I talk about poor accountability on the use of taxes, thereby, impairing any sense of social contract. The citizens simply don't trust the authorities that collect the taxes. And so they don't want to part with their money, even if they should. And so all forms of schemes of tax evasion, except for the ones who cannot evade, all others are figuring a way to evade or to avoid, which is, according to the tax people, a more noble thing to do than to evade. And then multiple taxation with difficulty on payments, just knowing what tax you're supposed to pay, information, just basic transparency, the lack of it. And then you also think in terms of the lack of consequences. So you don't pay tax. What does that mean? You don't pay tax, there's no consequence. That's different from many jurisdictions that we know. That you don't pay tax could be the end of a successful life. And then I talk about post-COVID-19 and the trade-offs that we have to, focus our minds on. There will be tension, and it's already there. It's a huge tension. It started very early when the health practitioners and the economic, types were having this debate. Is it going to be lives or livelihoods? The tension that exists in this COVID era and beyond it on these two objectives is that, if we say that our objective must be to raise more tax revenue, especially because post-COVID, there are now many more things that the nation state must get right. For example, on the continent of Africa, our health system is a total mess. We must invest in our health system in a way that tells us that it's not about just the new normal, it's the next many normals. We need to prepare ourselves ahead for those. And so the kind of nature of infrastructure, the kind of technology, can you imagine how woeful it was for many countries to be trying to figure out how to find their citizens in need, how to identify them, how to target them, how to reach them with any form of palliative. So the kind of expenditure that is necessary this time and post-COVID as stimulus to individuals and to business means that taxation is at the center of this conversation. However, we're dealing with a tension between livelihood and life. So this tension is going to also, percolate into conversation around how you do taxation at a time like this. If the IMF has tracked some 9 trillion of stimulus, can you just imagine? It is not in any way sustainable to just keep going with this without looking at the other end of the balance sheet. And there is going to come a time when that conversation must start. How do we start that conversation? With bearing in mind the necessity to not deepen the already bad inequality that exists within and across borders of nations. So I then follow with the tax stimulus, which focuses, I took an example of what happened in Nigeria. So a number of the states, some 36 states of the Federation, including Abuja, where we had a conversation around their state's fiscal transparency and accountability project. And they agreed to do some tax stimulus, which would focus on 5 main activities, allowing people and businesses to file their payments late, tax moratoriums, waivers, a reduction of penalty.
Hello?
Yeah, we seem to have lost her for a minute there. Do you want to, Alex, do you want to go to the next speaker so that when we get her back, she can conclude?
Yeah, I think so. Sorry for that. I hope we can get her back. But our next speaker is Professor Stephen Dean, who is the faculty director of the graduate tax program at NYU Law and professor of law at Brooklyn Law School. Professor Stephen Dean.
Hello, everybody, and good morning from New York, from Brooklyn specifically. It's really a pleasure to be with you all today. So many of those on the call, the Zoom call, I really hold in such high esteem. It's really a privilege to share a virtual stage with them. So much of the work they've done has paved the way for the kinds of questions I would like to ask, and I'd like to encourage everyone here today to ask and just to move us forward. So I'm just going to talk briefly about the work that I've done in my career and just really try to change the perception of what we're all doing. So for the first part of my career, most of what I wrote about was trying to explain to a US audience what the rest of the world looked like. And especially in the tax context, that was quite challenging. In one of my articles, I wrote about the Southern African Customs Union, SACU, and this was really quite confusing to folks. I hoped it could be a model for a new way of framing the global taxation social contract. But I think I was met with more blank stares than nods of comprehension. And now, really, what I hope to do is to shift things around and explain, maybe it's going to be more productive, explain to the rest of the world what is happening here in the global north generally and in the US specifically. And I'm going to explain. So before I went into teaching, I practiced at 2 global law firms, and there's an apocryphal story that they like to tell about one of them, the firm called Cravath, and one of its important partners was named Paul Cravath. And at one point, the other partners sort of steeled themselves, and they all decided to approach Paul Cravath, and they had a question for him. And they said, we've all been talking, and we've decided that it's time for us to rethink the way the partnership's profits are shared. And the apocryphal story goes that he said, that sounds great. I think you guys should think hard about how you want to split your half. So I see parallels, obviously, to the conversation we're having here and the conversations that are really important. When we think about the way the global social contract for taxation has been structured, it's uncomfortably like the partnership profits arrangement that Paul Cravath was so comfortable with. It's structured in a way that is appears neutral, but is really tilted in favor not of the global north, as has often been expected, but really in favor of cross-border transactions generally, which indirectly favors the global north, but operates a little bit differently than ordinarily is thought. Looking at the papers and the blog posts that were presented for this session, I was struck especially by Professor Christian's blog post, where she talks about representativeness. The three principles she identifies are representativeness, transparency, and sustainability. I agree with her that those are the principles we need to embrace. And what does that mean? So to me, what that means is that we need to rethink the structure, the fundamental way that we think about tax. In a paper that I'm going to present next week at the first session of the NYU Tax Policy Colloquium, and then later also with Professor Dagan, who I noticed is on the call. But the NYU Tax Policy Colloquium for the first time ever is going to go virtual. And those of you who are curious can participate not only in my session next Tuesday, but later sessions. Please feel free to reach out to me. I'd love to have you join us and join the conversation. But in that paper, what I point out is that from the US perspective, the global system of taxation operates quite well. It is an iteration of a concept that many of you know well, numerous clauses. It limits the forms of taxation that are permissible to a small number. And limits the ability of states to impose new taxes, which of course you'll all recognize is implicating the digital services taxes that are now creating such a stir and such a controversy in the global tax policy context. And I think it's time to revisit that fundamental structure. I think that when you take Professor Christian's three principles, representativeness, transparency, and sustainability, and you look at the structure that we have, this very limited and limiting numerous clauses framework, which was designed in an era, and of course it's helpful to think back not just to the very specific tax questions that we're familiar with, but to think about the broader conversation that was happening in the early 20th century when this framework was adopted. This was the era that brought us such standbys as time zones. You won't be surprised to learn that France resisted Greenwich Mean Time for several decades. They preferred Paris Mean Time. This is not surprising. But these were the structures that were coming into place. Postage stamps. These are all the very basic structures that were being created in order to ease cross-border transactions. And I think that the fundamentally neoliberal structure all from that era that we've sustained through today is it was never designed for the world we live in, and certainly not designed for the post-COVID world we hopefully will soon enter. And the its focus on limiting burdens, both procedural and substantive, on cross-border transactions has never been more of a problem. It's never been more of a problem, and the only way that we are going to move beyond that numerous clauses framework, classification and assignment is the formulation it takes in this space. In order for us to move beyond that, we really have to embrace the ideas that Professor Christians has put forward: representativeness, transparency, and sustainability. We really have to shift the entire framework away from this limited and limiting neoliberal framework to a system that can actually help us collect revenues. When I was looking back at a paper I published a while ago, I was reminded that the father of the system that we all must live with in the global tax context, Edwin Seligman, one of the core architects and maybe one of the most important, he was actually surprisingly familiar with the continent. I noticed that he published an essay in a book called Essays in Colonial Taxation, and it was focusing on the French colonial system. So it was interesting to know that he was perhaps more aware of the world than it might seem. But it's important that the system that we have and we rely on comes from a very different era, one in which the neoliberal goals of easing cross-border transactions was primary. And certainly in the post-COVID world, we are no longer there. And we need to rethink, we need to embrace new priorities. And I hope we all will. I'm excited to hear what the other panelists have to say. So I'm going to mute my mic and say a big thank you to Afronomicslaw.org, to the other panelists, and to the organizers for making the webinar happen, making the symposium happen. It's really an extraordinary moment. Thank you so much.
Thank you so much, Professor Stephen Dean. Thank you so much. I would go next to the next speaker, who is Professor Irma Mosquera, who's an associate professor at Leiden University. She would speak, and then at the end of every speech, we would get to the question and answer session. But just to say that for those who have questions, if you could just put them in the chat box, we'll get to them when the time comes. Professor Irma Mosquera.
Thank you, Alexander, and thank you, Afronomics, also for the invitation, and to the organizers. I think that in this time of social contract, we need to ask three questions. What is fair? What is legitimate? What is sustainable? And this is not only about now, in COVID or post-COVID, but it was also before. So when we're looking, for instance, in this project that we have about global tax governance that is funded by the European Research Council, where we look at the implementation of BEPS in 12 countries, we were looking also like, if the OECD and the G20 were the ones who decide the agenda, can this still be legitimate just because we are also addressing the needs of the developing countries? Can this be fair? Can this be sustainable? So we work also together with Wouter Leaps. He's also here in this call. We was working, looking what type of sustainable development goals and how we can achieve them. And then COVID-19 came. And interesting enough, the questions keep still being the same. What is fair? What is legitimate? What is sustainable? And if the countries are going to answer those questions, they will need to really figure out how to do it. And I'm not saying that I have the answers, because I also believe that each country has to find their own responses. At the same time, what I also saw in some of the blog posts in the social contract, is also important to have, for instance, a regional approach to exchange best practices and look what happens in Africa. Also within Africa, the differences between Northern Africa, Southern Africa, what happens also in Europe, what happens in Latin America. And I think that in this sense, the blog contributions organized by Alexander also gave a lot of view on this. So the question is then, if we are going to look at one of these elements, the first element what we can look at is, for instance, the tax incentives that has been also mentioned 3 times in the blog post contributions. And the question is, because as the representative, as the first speaker, Dr. Oby Ezekwesili, specifically say, it's not only about what is going out, but also what is coming in. And if you have and you are going to give tax incentives, you need to find out how you are going to do it, because at the end of the day, you will need to revenue to fund to have the business. So what happens there, and we published today a blog post in our blog, GloveTaxGov, on the tax incentives that has been also work that we have done in the last year. So this is not only because of COVID, but we started with the tax incentives, looking at also in light of BEPS Action 5. So the question is, now we have in COVID-19 tax incentives because we need to keep the economy going. And we are providing different type of tax incentives. We also know the OECD is having their own list. Also, the IMF is also recommending, and we have some differences, and it's not really clear, except for the IMF, who gave a specific recommendation, which type of tax incentive could be useful. But the question is, if we go back again to what is fair, are tax incentives and are fiscal stimuli for all companies fair? Are we talking about only multinationals? Are we talking about small, medium enterprises? Are we talking about multinationals who are good taxpayers? For instance, that they do pay taxes, that they do not have any subsidiary in low tax jurisdiction of tax havens? Or are we talking about multinationals in general? What is fair? And how I'm gonna answer to the individual, to the small, medium enterprises, that they are also need the fiscal stimuli to keep their business going or to keep their family going. So then, for instance, if we look at the individual, one of the things that I thought was very interesting, since we have discussing a lot about COVID and multinationals and so, but one of the things that I thought was interesting, and it's very difficult sometimes for people to understand, especially from a European perspective, is that there are people who live every day and they have to work every day just to earn the minimum. And no, I'm talking about the minimum wage. I'm talking about the minimum amount of money that you can have to put food on the table, the basic. But once we have the COVID, therefore, people are not able to go out because they have to be in isolation. And there was a proposal having and saying, let's give to these people a minimum wage. But again, if we are going to do that, what is the role of the international organizations in providing and helping developing countries in this minimum wage, this minimum that they have to pay their house, to have a place to live and to eat? So then when we look at what is fair, we really need to, and I think that governments and international organizations need to also discuss this. This is not about only a summary of these are the measures that we have for COVID-19, but it's also about having and asking the right questions and looking at the governments and saying, you need to address this. What is legitimate? Can we say to a rich person, you are not going to be taxed because, I mean, you are rich, you already have paid a lot. And we can say to a poor person, of a person who just depends on the basic income, yeah, but you are going to be taxed. So some countries, for instance, in Latin America, they are considering to discuss about the wealth tax. The wealth tax, the tax for the rich people. So an additional tax. However, one problem that you have there is that you have tax amnesties. And this tax amnesties means that you are going to be, okay, if you come and you declare, then you don't pay the taxes for this amount, or you pay it for a limited amount, or you pay it, but you don't have a fine for this. So then we are saying, let's create a wealth tax, let's tax the rich people, but at the same time, let's give an amnesty. And for instance, in Colombia, the country where I come from, is very famous on having an amnesty every time. They are now even having a commission to investigate about the tax incentives in general. I think that a lot of countries should also address these tax amnesties. And the question is, what is sustainable? And then that's one of my problems. If the others were not the problem, but this is also one of my problems. Because I have the feeling that what countries right now are doing, they are reacting on a short term. And it's not that it's bad to have these short-term goals, because of course it's COVID, you need to react quickly. But you cannot really, they are changing, for instance, in Philippines, they are having a comprehensive tax reform where they are looking at the tax incentives. Because of COVID, they decided now to change it and to add some COVID measures. And what they are doing is they are giving the discretionary power to the president to grant the tax incentives. The question is, if we are looking towards a framework that can be sustainable for tax incentives, whether they are bad or wrong, of course, there is a lot of literature on that, but we have to touch the reality. And the reality is that countries need tax incentives. The question is how we are going to do this evaluative framework, how we are going to evaluate this. So if we are saying right now let's have short-term goals. Let's have one incentive and let's give discretionary power. I don't know, we're having a step back, and we're not really looking at now. Actually, we are not talking about transparency anymore. We are not talking about accountability anymore. We are in times of need, therefore we need incentives, and if we give it to the president, it will be easier. Without having to discuss any other political issues, I think these are my 3 questions: what is fair, what is legitimate, and what is sustainable, and this should be addressed in the social contract. Thank you.
Thank you greatly, Professor Irma. Thank you. I sort of appreciate all the questions that come in already. What is fair? What is legitimate? What is sustainable? And also, when you go back to Professor Stephen Dean's representation and also transparency, I think that I assume that would be sort of the crux of the Q&A when we get there. Just to say also that people could keep sending in questions, and we'll read out the questions when the time comes. For some reason, we had lost Dr. Oby Ezekwesili. Just to say that we would give our time when the other 2 speakers are done speaking for her to give her closing remarks. I see she's back. I think she's reconnected, and would come back to her at the moment we hear from the other 2 presenters. Next person is Mr. Thulani Shongwe, who is the head of resource mobilization at the African Tax Administration Forum. And I'm sort of, really excited to hear what the supranational bodies are doing and how their activities connect to social contracts at the global level, but even also at the national level. Mr. Thulani Shongwe.
Thank you very much, Alex. And I'd like to thank the organizers for inviting Ataf and myself to participate in this wonderful event. Thank you to the other panelists as well, who have certainly laid down the foundation. And if I can refer to the professor's keynote address, when we're looking at the performance of taxes on the continent, it seems as if for the last 5 years, the performance of tax collection, the economic growth, have not tied in as they should. A tax to GDP ranging between 15 and 17%, depending on which data you read, is not reflective of the kind of growth we've seen in some countries of 6 to 9 and 10% in some instances. So that is quite concerning. And the reason I'm pointing this out is because this is where we need to measure whether the taxes that we collect are really performing and forming part of that social contract that we're speaking about. Additionally, when you look at the performance of some of the taxes, we see largely that it's the indirect taxes that are contributing. Now, from an ATAF point of view, we think that's twofold. Indirect tax, VAT, is far simpler to collect than some of the international taxes attributed to corporate income tax, like transfer pricing, where the audits take longer time. And then the second reason is that, well, it's an indirect tax that is effectively applied to everyone. And as some of my colleagues have indicated, the low-income earners seem to consume more, and low-income earners, of course, pay more in terms of not getting the opportunity to get rebates or to get tax-free loans and so forth. So you're seeing a disconnect here, and it particularly plays itself into this conversation that we're having around the social contract. When COVID-19 pandemic hit the majority of our countries on the continent, the first thing that we all advised was to provide some kind of tax relief to taxpayers. This was in the form of either a suspension of payment or suspension of penalties and so forth. Interestingly, and as Irma has referred to, tax incentives play a crucial role, but also have a negative role in some instances. One area that we've picked up on is in this tax relief environment, we also need to have a social contract with taxpayers, but citizens at large. So the taxpayers, the big contributors to the tax take in the form of corporates and multinationals. They form part of the social contract. In many countries, of course, they use the infrastructure to conduct their business and so forth. But also we have to guard against whether the social contract is being protected by the taxpayers themselves. What we're guarding against is a situation where these reliefs and these provisions that are put in place as emergency regulations are being exploited for, say, force majeure in mining instances. We need to guard against that. Companies that would naturally be making a profit or naturally breaking even don't use the pandemic as an opportunity to extend tax holidays or extend relief measures, thereby creating de facto tax holidays. So that's an important element we need to ensure in terms of the relief we offer in building the social contract. I would also like to add that COVID-19 brought about a situation that we certainly witnessed here in South Africa, where you have a lot of people who are at home and where you have middle income earners and people with disposable income. You're sitting at home, working at home, but you also have the opportunity to procure or purchase. So the increase in online sales of goods and services has obviously increased. And certainly that puts pressure on revenue administrations and tax policy alike to say, what are the measures you are putting in place to collect this additional revenue that is coming from such activities? Of course, in countries like Kenya, there's been the introduction of a digital services tax. And in Nigeria, there's been the introduction of the significant economic presence provisions in their regulations. But of course, interestingly, is when we're looking at the DSTs, many countries are also afraid of putting such a levy type tax or withholding type tax on digital services in fear of a possible retaliation from the US government, as we've seen in the ongoing discussions that are taking place at OECD level, but also in the interaction between the USA and France. So countries would like to introduce such measures, but of course cautious that these measures don't lead to unfavorable conditions imposed upon them. So again, when you're looking at the areas that the pandemic has forced us to focus on, it has to do with better analysis of our revenue, but also better collection. Moving forward, I think that the discussion around the narrow tax bases on the African continent will have to evolve to how do we expand these tax bases. There's certainly talks of introducing wealth taxes where appropriate, but there's also the constant need to balance between a fair tax system that is broad in scope and that taxes fairly across the range. So in moving into a post-pandemic environment, certainly revenue collection is important, but equally important to that is what is that revenue collected being used for? I was quite surprised to come across a trend this morning on Twitter where a number of youth on the continent are speaking of what we call COVID millionaires. And these are businesses that have benefited, whether through exorbitant tender pricing and so forth, in gaining substantial wealth by supplying COVID materials. And that again speaks to the issues that are around the social contract. If we don't use this opportunity to ensure that the revenues collected through the narrow tax bases are actually used to increase healthcare and increase hospitals and public goods, then we're headed for a very difficult road in a post-COVID-19 era, where the pressure will always be on revenue administrations to knock on the large taxpayers and try and collect as much revenue out of them And we already know how difficult that is because of aggressive tax planning, offshore accounts, and lengthy audit processes. So without wasting much time, colleagues, and looking forward to a number of the discussions that should evolve out of this, I think the most important thing in a post-COVID-19 environment is ensuring that where revenue is collected, that government can show its citizens what it's done with it. Thank you very much.
Thank you so much, Thulani. Thank you so much. Again, we'll come back to the different elements of your speech when we get to the Q&A. I'll call on the last speaker, Dr. Fred Mugambi, who is a commissioner at the Kenyan Revenue Authority and also the head of the Kenyan School for Revenue Administration, KESRA. Dr. Fred Mugambi.
Thank you very much, Dr. Alexander. I want to join my colleague panelists to thank Afronomics for organizing this very important discussion. And I want to say good morning, good afternoon, good evening, wherever you are in the world. In Nairobi, it is just 10 minutes to 6 p.m. and we are happy to join this conversation. So my focus will largely be on COVID and its effects on my continent, which is the African continent, and of course on my country. And I think what is important for us to note is that COVID-19 has not only affected, from where I'm coming from, has not only affected tax revenues, but it has also, in a very large way, restructured economies, and possibly restructured economies in ways that we could not have foreseen 1 year ago. But before I can come to the restructuring of economies, let me talk about tax. Generally, what we have seen, especially in Africa, is that the traditional methods of collecting taxes, which has been basically focused on taxes like pay as you earn and VAT, are changing. We are seeing more of our trade moving into the digital space, which then means that services are being rendered largely through the physical, through the digital space. And that then means that it becomes very difficult to collect taxes, and we are quickly having to restructure our method of tax collection to be able to tap into the digital space. Now, but let me talk about the restructuring that we have seen as far as economies are concerned. First and foremost, we do know that tourism has been affected greatly. Our countries are largely dependent on tourism incomes. Most of the African countries are largely what one would call consumption economies. And therefore, we have a lot of consumption trade happening between ourselves and, say, China. And to just give a statistic, importing 1 kilogram of cargo by air from China to Nairobi has moved up from about $8 to about $12, $13. You can see that is a cost that is already translating to price increases. Now, where are we moving to as far as our economies are concerned? Where do I see ourselves moving to in the next several days? I think it will be important for us to relook at our structures as not just tax revenue administrations, but also as countries and also as regions. We need to strengthen international cooperation. And here, when I talk of international cooperation, I'm, for example, looking at regional blocks that we have within not just Africa, but across the globe. I want to give a very quick statistic. Intra-regional trade, intra-African trade, sorry, accounts for just about 16% of all the trade that we do with the rest of the world. In other words, Africa is trading more with the rest of the world than it is trading within itself. This needs to be restructured. There is a disaggregation between the relationship between, say, tax and GDP, and tax, for example, and other areas like service provision. Again, let me give an example. You'll find that agriculture in most of our African countries contributes upwards of 30% to the GDP. But it also contributes just about 2 to 5% to tax revenues. Now, that means that we have a very narrow source of revenue compared to the contribution of those sectors to GDP. It is therefore imperative on African countries to not just look at revenues, but also to look at the structure of our economies, because in my opinion, the future will largely depend on how we restructure our economies. If we do not restructure our economies so that then we have more production, more manufacturing, and therefore we start moving towards more of a production and processing continent, as opposed to remaining more of a consumption continent, then we are likely to find ourselves in deeper dependence challenges, where then when we're faced with problems like the COVID-19 pandemic, we'll have to run to the development partners. Finally, as I come to the end of my sentiments, I want to mention that technology will be an important focus for us. We have to deepen technology penetration within our countries, because again, most of our transactions are moving into the technology space. So will collection of revenue. It will be important for us to kind of focus on our strengths, so that then we look at what resources that we have, build some value on those resources, and therefore expand our value chains, because we have very few value chains that we are relying on. So expand our value chains so that then we are able to expand our tax basis. And so, Dr. Alexander, those are some of the sentiments that I would like to share with our audience this evening.
Thank you so much, Dr. Fred Mugambi. Thank you so much. Really grateful. I just call on Dr. Oby Ezekwesili for the next 2-3 minutes, sort of give a concluding remark. Again, apologies for the disconnection. We still can figure out what happened, but if you could just in the next 2-3 minutes give our concluding remarks, and then we'll go back to the Q&A. I've got some questions already that have come in. Keep sending the questions, and then we'll go over to that after Dr. Oby's concluding remarks. Thank you.
Well, thank you very much, Alex. I just have a few things to say to bring it to a wrap. What I was saying, perhaps that was when I was cut off, was that the relationship between tax equity and capitalism is definitely something that a lot of attention has to be paid to as we look at the way going forward. And then specifically for our continent, I did say that as natural resources revenue continue to, show this level of volatility and reveal that that's not the pathway for our continent, the question that we have for our continent as far as taxation is concerned is there a strong will to embrace the depth and breadth of economic structural reforms that we need in order to expand the tax base for our continent? Our tax base is too limited. It's simply too narrow. And this is our opportunity to really do the toughest of things that are necessary in the space of economic reforms. And added to that as a rider is the fact that as we look at 2035 as a time when maybe some 25% from a current estimate of the GDP of the world would be digital economy. How prepared are we as a continent? How are we reflecting that in our policies and in our tax administration capabilities? Then I ask for our continent, is there a commitment to improving the state's capacity to collect tax and to deal with the issues of administration and tax equity efficiencies? These are really important issues, and these are determined by the quality of the bureaucracy that we have. Africa's bureaucracy is grossly eroded in terms of capacity. People like you, Alex, are hardly running to come back home and administer these kinds of agencies where we need the highest level of competencies and skill set. And then I talk about how about social capital, which is public trust in government. This is grossly eroded. It is grossly eroded, and it will keep people not wanting to do to hand over their money to government. And even my final point in terms of Africa is have we in some of the environments where we have seen payment of tax, reasonable payment of tax, it hasn't in any way reflected in the demand for accountability. So what is this payment of tax and poor demand for accountability problem that the continent has? What is driving that? That is definitely a matter that requires some scrutiny because it's puzzling. And then to the world, I say that can the world collaborate for a swift reform that would take the world back to the path of economic growth? I talk about digital taxation and what it means for collaboration, especially in a world where we're seeing less collaboration. And yet we know that, we either go together or we all sink together. So how are we going to get into the world of digital taxation and the collaboration necessary to make it happen? And then I focus on illicit financial flows. I say that a global response is required for this. These illicit financial flows and cross-border transfers that use weak global taxation systems to evade taxes, especially in developing countries, exactly the countries that cannot afford to have these flows going out of them. According to research by the World Economic Forum, which, by the way, I chair the Africa program at the World Economic Forum, about 40% of multinational profits, or 650 billion, are shifted out to such tax havens by multinational firms from all countries. There are no angels amongst the countries. The price tag on this type of behavior is unbelievable. It's unbelievable for the poor. And I take to the direction that where are the big ideas for reviving the global economy post-COVID-19 so that we can at least have a basis for imagining that we can get more tax collection that would enable critical investment in infrastructure in the development of human capabilities, especially in places in Africa. And I say that we need to look at a complete reorganization of the production systems of the world. Africa needs to prepare itself to bid for a production system. We've got to decentralize it. If COVID taught us anything, it taught us that concentrating all our production systems in one jurisdiction is stupid. So, there's no other way to describe what happened. So we need to decentralize the production systems of the world. And Africa needs to prepare itself to be a destination that can attract the kinds of investment that are going to be needing a destination. And then I talk about accelerating the new digital technologies underpinned with machine learning and artificial intelligence. I talk about climate smart agriculture system, and I talk about expanding energy technology. And finally, I say to us that taxation that fulfills optimal definition of social contract at a time like this will be one that is designed to place citizens at the center of recovery of both their lives and their livelihood. That is, for me, the greatest lesson of COVID-19. It has embedded a tension between life and livelihoods, but this tough extension into how countries would use their fiscal tools to resuscitate lives and livelihood has made us to realize that health is not merely health. Economy is not merely economy. Health is economy, and economy is health. And at the end of the day, all taxation is politics, and all politics is local.
Wow.
Thank you very much. Thank you.
Wow. Thank you very much, Dr. Oby Ezekwesili. Thank you very much. There's so much to chew on. Thank you very much. We're sort of running out of time, so I'm just going to go straight into the questions. And what I'll do is for the first round, I would just ask the questions to the panelists. I'll read a question each, and then I'll call on one person to answer, and then the others can prepare for that question. Just to everyone, someone has asked the question that, is it better to have 1% tax paid on the income of people, on the gross income of people or companies, rather than 20 to 50, 70% that never gets paid? Sort of a minimum tax conversation, just to everyone. For Irma specifically, someone has said, could you elaborate more on the tax amnesties granted to wealthy people in Latin America? How do those amnesties hamper or impact abilities to implement wealth taxes or a more progressive tax system in Latin America? Could you talk about the situation of amnesties in Colombia a bit more? A bit more. Thulani, a question for you says, one of the issues that leads to the lack of trust between governments and citizens is the issue of tax evasion, illicit financial flows, and corruption as a whole. What is ATAP concretely doing currently in collaboration with African governments to deal with this? Also to Thulani, could we think of using registration of persons, their trades and profession while they are in school, trade school and professional school as a means to broaden the tax base? To everyone, we've seen cases in Africa where governments keep increasing taxes as opposed to broadening the base. And also when politically connected corporate transactions like mergers get tax exemptions, does this run afoul of the social contract? I will start with Stephen Dean to respond to the broad questions. Then those specifically mentioned, we get there. I'll call the next person. Thank you, Stephen Dean.
Wonderful. Thank you so much for the amazing questions. And as I suspected, the conversation is just really, really wonderful. I've learned so much from the other panelists, and now the questions are fantastic as well. I would say that in response to the second broad question, I do think that the narrowness of the base, this is a theme that came up in several of the presentations. I do think that is a problem, well, depending on your perspective. As I say, when the other partners go and say to Paul Cravath, the man with all the money and the contacts, how about we broaden our stake in the economic arrangement? He doesn't even understand what they're asking, right? It's hard for him to understand what it is that they want. And when we talk about broadening the base on which taxes are imposed to include mergers and acquisitions and cross-border transactions to an extent that the system is not currently designed to do, I think that's essential. And the only way we're going to get there is for those who are most directly affected to understand that about the tax system, to understand that the narrowness of the base, the exclusion of mergers and acquisitions activity and so on, is not an accident. That is part of the structure. and part of the reason that the base is so narrow. I'll leave it there rather than going on, but I really am excited to hear what other folks have to say about this conversation.
Professor Irma, in addition to responding to the general questions, if you could also address the questions that have been directed to you, Professor Irma.
Yes. I will get first to the general question, whether it's better to increase the tax base or to expand the tax base instead of increase the tax rate. And one of the things that, for instance, in Colombia, what has happened is that normally the tax rate is more than 30%. And how this has been done then? The way to attract investment is to have tax incentives, and in certain cases, for instance, to have a tax holiday. So this tax holiday where, for instance, hotel business, so the tourists, the hotels, will be granted an exemption for 20 years. And that's a lot. And the question is now, they are now in Colombia now, they created a commission to review the tax incentives. But there is still the difficulty, because if we don't say that we need to have a 1% tax, because I do think that especially with glove, this 1% will not work. But it is not possible to have a tax system where you have, for instance, in a country like Colombia, to have more than 30%. So there should be a balance in between. What can we say? I will not say this, make it 20 or make it 25. For instance, the ICRIT, the commission has already said that the minimum tax for the glove should be 25%, I believe. But there is this difference. So we need to really be careful what we are doing. Are we really having this increasing of tax rates, but at the same time, the tax base, and we give so many tax incentives to everyone and even tax holidays? Is that the thing that we want to do? And regarding the tax amnesties, there is unfortunately, all the information I have on the things I have written are in Spanish. But there is a book called Tax Amnesties by Jacques Mahelber, and I will copy that in the chat, from 2011. So what happens is that this discussion of tax amnesties is not only in South America. So for instance, Argentina is very famous on that, also Peru and also Colombia. But interesting enough, 2 years ago, when I went to Turkey, we were also talking about tax amnesties. So then it was kind of interesting to see that. So what happens then? For instance, in Colombia, you have already 3 and going to 4 tax amnesties. Some of them, they say, well, this is a tax amnesty, and therefore the Constitutional Court say this is not constitutional. So they decide that we don't call it tax amnesty, but we call it something else, but it's the same, kind of. So, and the question is then, in this case, for instance, they say, well, you will have a specific period of time and try to figure out what a specific period of time is. Because if you say, as of next week, all the assets that you are declared that you have, for instance, in other countries outside Colombia where you have no pay taxes, all the assets that you have not declared, then how will start the tax planning? What do we need to do? Do we need to move those assets somewhere else, or how we are going to happen? Of course, with the change of information, things are changing. But then you say, we have these assets, you need to bring it to the country, you need to declare them. But if you don't do that, I will give you a fine. And normally the fines could have a confiscatory effect, because could be 160% or 200%. Of course, now with the change of information, this has also facilitated that, for instance, between Colombia and Panama, there is also a lot of information now coming of what Colombians will have in Panama. So in this case, then you say there is a specific period of time. If you don't do it, then I'll give you a fine. It will be kind of a confiscatory fine because of the amount. But also, there are 2 points here. First of all, what is an asset? Is only the bank account, so it's also if you have real estate. And the final point, because I'm really running out of this, the final point is which rate and which tax. Are you going to have a wealth tax and you are going to put there, or if you are going to have a 10% rate of which rate do you have? So there is a lot of issues here. And for that, I will recommend this book, and hopefully may have to write something in English about this. Okay.
Good. No, thank you so much. Sorry, we just have 15 minutes more. So could I plead with everyone to make the responses really short so that we can have, we can sort of respond to all the questions. Dr. Ezekwesili, there's some questions for you, but before I call on you, I would call on Thulani. In addition to the general committee, we could also speak on the ones that have sort of been referred to you. And after Thulani, Dr. Mugambi, then we'll go back to Dr. Oby. But I've seen a lot of questions coming in and we're trying to get them as all answered as possible. Thulani.
Thank you very much, Chair. The general question, I think a very straightforward answer, not necessarily the right answer, is it actually depends on the kind of country you have. You know, do you want to leverage a 1% on everyone, or, you know, take your chances on not getting 20, 30, 40%? A simple example is the country I live in, South Africa, has huge inequality. So if you were to leverage 1% on everyone, the poorest of the poor would battle to pay that 1%. And the rich, you know, would say, well, it's just 1%, and it might be substantial, but it's 1%. The bigger issue here is that the tax system you design should try as much as possible to be equitable as possible. The more outdated the system is, the easier it is to aggressively tax plan against it. Secondly, the level at which you administer your taxes will determine whether people keep their money in their country or run offshore because they don't want to see their taxes degraded by the system. So that those are just elements, food for thought. Specific questions to me around what is ATAF doing around illicit financial flows with governments? Two things. Firstly, combating illicit financial flows is a whole of government approach. It's not just one element of government. There's major parts and moving parts to illicit financial flows. Certainly tax is one of them, aggressive tax planning, evasion is one of them, but there's also terrorism financing, drug trafficking, human trafficking, and all of that. So it's more of a whole of government approach. In terms of the second part of my intervention here, what is ATAF doing specifically? We are implementing 6 of the recommendations from the high-level panel report, specifically focused on transfer pricing units, establishing transfer pricing units. We've done 12 of those so far on the continent. We are looking at increasing beneficial ownership legislation. We have done 2 of those on the continent. We're working currently with amending Botswana's Financial Act Bill. Accessing double non-taxation agreements. We are currently proposing that the wording in the original ATAF DTA should be used by all African countries, with reservations by those countries that have reservations on particular articles. That is currently being championed by the Pan-African Parliament. On exchange of information and transparency agenda, we are implementing a program on competent authorities and training of competent authorities. And all of this is part of the contribution we're making to fighting illicit financial flows. And then there was a question addressed to me. I can't remember it off the top of my head. Yes, about the expanding of the tax base. Again, I think the simple issue here is not necessarily registering people's professions when they're in school. The simple issue here, which is a recommendation that comes out of TADA, is registering individuals with an income tax number from birth even. And once they get formal employment, it'd be easier to track them and apportion whatever taxes that are due to that particular tax number. And I think in a lot of countries, we need to clean out that database and ensure that individuals are properly registered and that the administration has a proper and up-to-date tax register. Thank you.
Thank you so much, Thulani. Dr. Mugambi, so in addition to the general comments, there's specific questions that have been directed towards it. I've got a lot of questions around the digital service tax that Kenya has introduced. So someone has asked that if African continent is thinking about DST, then we need to understand the tax planning of multinationals. Dr. Mugambi, do we take the trouble to understand the structures of companies? And is it a requirement of our bureaucracy that multinationals provide such information to the Revenue Authority? Then secondly, on Kenya's digital service tax, how is KRA ensuring that the taxes do not overtax small local enterprises, considering that big technology companies are negotiating for better tax conditions in bilateral negotiations? Dr. Mugambi.
Thank you very much for those questions. I think one of the challenges that every revenue authority, and not just revenue authorities, but countries face is the whole question of applying equity when you're taxing. Basically, the balance here is to make sure that you do not create what I might call tax fatigue in some sectors at the expense of the others. And therefore, one of the things that as a Kenya Revenue Authority we are doing is to ensure that we disaggregate the two levels of the digital economy as we see them. We have what we are calling the local digital economy and the international level digital economy. Those of us who understand Kenya well know that a lot of our payments are now done of mobile money platforms. We are quite ahead on that, especially the M-Pesa system. And so that then is at the center of the local digital economy. And for that really, it is quite easy. So we are working with these platforms to ensure that goods that are bought across those platforms attract the necessary taxes, because we do not think we need extra laws for that. But then we have the international level digital economy. This is where, of course, you bring in social media platforms like Facebook and all the others. And unfortunately, it is important that international cooperation, supports this. It is not possible for us as a continent or as a countries to be effective, optimally effective in taxing these international social platforms if, for example, we do not, as a united, world, achieve a position on how to do that. And that is where, for example, the inclusive framework comes in very, very importantly. And it is our hope that when that is done, then we will be able to define, for example, a permanent presence in a manner that ensures that smaller countries can also be able to get their fair share of taxes, especially when those taxes, incomes are derived from those particular countries. And the final one, Dr. Alexander, I think had to do with how we ensure that small users or enterprises are not overtaxed at the expense of larger taxpayers.
Yeah, that's right.
Yes, absolutely, absolutely. And so one of the balancing act that, again, like I said, we do is to ensure that we are able to apply our tax regime really based on income. And one of the laws that was passed in this country, in my country, a few months ago, was that we would increase the minimum non-taxable income, and we also reduced PAYE, we reduced VAT, we reduced corporation tax, just to help citizens to weather the pandemic period. And it is important, of course, that African governments be sensitive to their taxpayers, and Kenya is trying very hard to make sure that that is done. Of course, there is a whole issue of ultimately eroding some of that tax because of those measures which then has to be evened out in other ways, for example, by tempering incentives.
Thank you so much, Dr. Mugambi. Before I call Dr. Ezekwesili, I would read the last question. There's one question for all speakers, just so that you all reflect on them, and then everybody has 30 seconds to just respond quickly after Dr. Ezekwesili's response. So the question is, in your countries of expertise, would the pandemic strengthen the social contract among individuals and facilitate taxation in the future, or rather make things more difficult? In your countries of expertise, you could chew on that. While Dr. Ezekwesili, two specific questions for you. One is on digital taxation. As the chair of the Africa program on World Economic Forum, what projections has the AFCFTA made on taxation of intellectual property? Since this is a major source of tax-based erosion, what balance is Africa creating between free trade and optimal taxation? Second, are tax incentives effective means of expanding the production base of Africa? Dr. Ezekwesili.
So, well, quickly, I think that the AFCTA is within the realm of the Africa Union and its other sister organizations, as well as the nation state. The only thing that we do as World Economic Forum and the Africa program is to be partners to support the process of the regional economic integration and the matter of digital economy and taxation as an important part of the conversation around IP and technology, movement of people, movement of talent, movement of labor. That's going to be a whole big agenda on which there is work already going on. And I think that the UN Economic Commission for Africa is, they are members of the World Economic Forum Africa program. And so this is a conversation that is going on at this time. And then on the question concerning what was my second question now? Oh my goodness. What was the second question? I lost my thought.
I'm sorry, are tax incentives effective?
Yes, are tax incentives. Look, you've got to disaggregate this. I wish there were a general answer to it. But something that is much more general that we have seen, and I saw a lot of it as, when I had to interact with economists on the continent, is that those tax incentives are the hotbed of influence peddling, corruption, nepotism, all kinds of incestuous relationship between business and government. And so it is something that we must be careful about. I think that a much more transparent and industry-wide approach at supporting our environment to be low-cost region is more effective for us than just these under-the-table waivers that are sometimes granted and never, ever stop being granted. We create monopolistic situations as a result of these kinds of ways of supporting business, and we have to be careful about that. Finally, to that question is that when we talk about expanding the economic base for our continent, I think the fastest place to start is to look at our informal sector. It is today more than 70% of the economies of many of our countries, and it's because it's low productivity. All we need to do is to identify what the barriers are to higher productivity of our informal sector so that we can move them from informality to formality on the basis of really well-defined, transparent, very rational, very social good optimizing, policies, not ones that, we give to friends and relations and end up with greater capture of the nation state by a few of the parasitic political class. So on the general question that you asked, Alex, I kind of think that, we ultimately would have to reflect a little bit more on what kind of world economy we're going to have post-COVID. It's very clear that there is conversation to be had Unfortunately, the two countries that are leading economies today that are at war between themselves are totally irresponsible in the way that they are acting at a time when we need true leadership to enable economic governance conversation to happen. We cannot afford to leave too many people struggling for life, struggling for livelihood. The level of poverty, I mean, I was looking at a recent World Bank study that's telling us the daily increase in the millions of people that are poor. The target for overcoming extreme poverty was 2035. And now it's not looking that good, and especially for our continent. And let me tell our continent that our business is our business. Our business is not, if the world comes around, that's okay. But we've got to pick ourselves by the bootstrap and make the matter of becoming vibrant economy the business of those that choose to say they have the capacity to governance. It's time that the African citizens rose up and decided that enough is enough with mediocrity at the center of our livelihood and our lives. Thank you.
Thank you. Thank you. Thank you so much. So I'd call on Professor Irma, 30 seconds, your final response, and then every other person. I'd just call 30 seconds, please. We'll actually overshot the time. 30 seconds.
30 seconds. Just one thing. It will make more difficult. And the reason is because it will raise inequality. And before it used to be like people will complain about corruption, of not paying a lot of taxes, but now it's also about the minimum livelihood, what you need to live. And this is what COVID has created. And this is not something only of BEPS that we used to do before when we look at that. And I mean, we have here Frederick and Juliana who are PhDs doing in that, but this is something more than that. So we are not really talking only about base erosion and profit shifting. We are really, and that's the reason why I like this topic, social contract and inequality.
Thank you so much, Dr. Mugambi.
Thank you, Alexander. I think in the short term, the contract might seem weaker, but in the long term, it will be strengthened. And in the words of one African scholar, the late John S. Mbiti, I am because you are. And since you are, therefore I am. And therefore, I think one of the things that COVID-19 pandemic has taught us is that we all belong to each other. The US will not be able to run on its own. India will not be able to run on its own. Kenya will not be able to run on its own. And therefore, the importance of international cooperation cannot be gainsaid. And in Africa, we need to restructure our economies and align our tax systems to changing business and landscape patterns. Thank you very much.
Thank you so much. Thulani.
Thank you very much. I think that the social contract will strengthen. The challenge that most Africans have seen is the deplorable state of our healthcare system and the fact that it's taken initiatives and innovation by individuals themselves to come up with solutions. So I think it will improve. And I think the state is now in a position to broaden its tax base moving forward. We've borrowed a lot of money that needs to be paid back. So there's going to need to be innovation and thinking moving forward. Thank you.
Thank you so much, Thulani. Professor Stephen Day.
Thank you so much. Very interesting to hear everybody's thoughts. I think that what we're facing right now is a real moment of opportunity, for the kinds of conversations that we're having here today that could create an improvement in the way global tax occurs, but it's not a certainty. So I think what's unique about this very moment, these times, COVID is part of it, is that change that could not have happened a decade ago could happen now. Only through conversations like the one we're having today and through the work of the people participating in the call today can it happen. It is not a certainty. So I think there is a unique opportunity for change, fundamental change in the social contract of taxation that could occur, but is not certain.
Thank you so much, President. So I'll hand over to Professor James Gathil to give the concluding remarks. But thank you so much to everyone. Thank you. Thank you. Thank you. Professor James Gathil.
Well, thank you so much, Alex, for moderating this excellent session. I really first want to thank the audience. You've been very patient and excellent questions. I want to thank the speakers as well they logged on half an hour before, so they've been on, for about 2 hours now. We appreciate you taking time from all the important work you're doing as government officials at the regional level, at the international level. I must say, Dr. Ezekwesili, that I never thought the tax could be this exciting. I love your passion. I thank the speakers for really bringing this conversation to a really very high quality, high level quality discussion. And I just want to say that, this is not the last tax webinar we are having. We're going to have another one in November, so stay tuned. Alex, of course, is always cooking something. Don't forget all the announcements that have been made, including by Stephen Dean about the event at NYU next week. But I also want to let you know about some other things that we are doing here at Afronomicslaw. I see on the call also on this webinar is Monica Victor, who is organizing another symposium for Afronomicslaw on taxation and the digital economy, Latin American and the Caribbean regional perspectives. I think Professor Olabisi posted on the chat the call for those papers. They are due September 15, 2020. We are really delighted to continue that conversation. So, start writing and send those blog posts. Tomorrow on the blog, we start a new symposium, a written symposium on vulnerability in the trade and investment regimes that followed our third webinar. So stay tuned for that. It's a really great symposium, raising many of the same issues we've been talking about today, but now in the context of trade and investment. And it's organized by Professor Olabisi and Claire Gamage. A really wonderful symposium. I encourage you to take a look at that. Our next webinar immediately, after this one today, not today, is going to be on Tuesday, September the 1st. It's going to be on the Kenya-US Free Trade Agreement. Don't miss this. There are going to be former officials of the US Trade Representative's Office, the Professor Kathleen Clausen of the University of Miami. There's going to be Professor Alvaro Santos of Georgetown Law School, who was at the beginning of the negotiations of the US, Canada, Mexico Free Trade Agreement, was the deputy lead for Mexico in the negotiations. And there's going to be a third speaker as well. So stay tuned for the announcement, which is going to be coming this week. And the last announcement I have is that we're going to be launching in about a month or less the African Journal of International Economic Law. It's a really great first issue with high quality articles. They have taken more than a year to write. There's one fantastic one on tax from a great author. We'll be announcing the masthead with all the titles of the articles and abstracts in about a week. So don't miss that. It's going to be completely free. The idea here is to completely upend the production of high quality work that is behind a paywall by the big publishing houses that makes this inaccessible. So just like this webinar is completely free and accessible to everybody, the journal is going to be completely free and open to everybody. And we have taken lots of time to make sure that it's high quality African standards, not global standards, African standards. I see Stephen Dean is smiling there. So thank you again, everybody, for being here today. We appreciate your taking time to be with us. And again, thanks to our speakers and you, our audience. We couldn't do this without you. And until next time, we'll see you. Keep well and keep safe.
Bye-bye, everyone.
Bye. Thank you very much.
Thank you so much.